We'll get started now on the webinar. Welcome to Dorsey and Whitney's webinar, Regulation A+, New Financing Opportunities for the U.S. Markets. This webinar is being presented by the Seattle, Denver, and Minneapolis offices of Dorsey and Whitney LLP. Dorsey and Whitney is an AmLaw 100 law firm with a deep roster of corporate finance attorneys based in our offices throughout the United States, on both coasts and in between, as well as in London, Hong Kong, and China, and Canada. Each of today's three presenters is a partner in Dorsey's Capital Markets and Corporate Compliance Practice Group, who focuses a significant portion of his practice assisting companies raise money in the public and private markets. In this webinar, we'll discuss the changes to SEC regulations that are expected to take effect tomorrow, known as Regulation A+, which will allow certain U.S. and Canadian companies to conduct public offerings of up to $50 million without becoming full SEC reporting companies. Our presentation will be divided into three parts. First, we'll provide a brief overview of the Regulation A exemption as in effect prior to these amendments and the origin of the amendments that are just now taking effect. Second, we'll explain in detail who is allowed to use new Regulation A+, what types of offerings it can be used for, and what companies are required to do to comply with the exemption. Lastly, we'll provide our thoughts on when Regulation A will be most useful and where we think it won't be very useful, focusing on the types of companies that we think will be most likely to rely on Regulation A+. During the presentation, we'll have participants in listen-only mode. However, if you want to ask any questions of the presenters, you should see on the left side of your screen a white chat box. You can submit a question by typing it in that box. We'll attempt to answer all questions that have been submitted either at the end of the presentation or by following up with you afterward individually. Our first presenter is John Abram, who is a partner in the Capital Markets and Corporate Compliance Practice Group based in our Minneapolis office. John advises public and private companies as well as investment banks on debt and equity offerings in public and private capital markets. John?
Thanks, Chris, and welcome everyone. I will kick us off here with a brief overview of how we got to this new regulation and kind of the overview of what is included. So prior to the recent rulemaking, there was before this what we call old Regulation A, and it was frankly a morbid exemption under 3B of the Securities Act, which did provide for an exemption, did allow you to have a public offering of freely traded securities, did not require ongoing reporting, but it was rarely used. It was limited to U.S. and Canadian issuers, which is not necessarily a significant limitation, but it was limited to $5 million in total proceeds, which really made it not a very useful process when you consider that you had to prepare and file with the SEC an offering circular, and in addition, you did not have an exemption from state securities regulations, so you had to qualify in each state. So, you know, at prior to these changes, it was not a frequently used exemption. The background to the new regulation, Regulation A+, really comes up in the Jobs Act and the attempt of the Jobs Act to provide expanded and enhanced ways of capital formation. And as part of the Jobs Act, the Securities Act was amended. 3B was bifurcated between 3B1, which was the old $5 million exemption, and a new 3B2 through 5 of the Securities Act. And this this change to the Securities Act provide for a new exemption, and that exemption would be available for issuances up to $50 million in every 12-month period. It permitted the public offering of those securities. Those securities would be freely tradable, and it included other things such as testing the waters. It also included, however, the authority of the SEC to provide for reporting as a condition to using this exemption, and included in that, that those amendments to the Securities Act was an annual audited financial statement requirement under the $50 million test. So that and mandated SEC rulemaking. So that change to the securities laws mandated by Congress is what led the SEC to adopt Regulation A+. So the Jumpstart Jobs Act was in 2012. The SEC proposed the rules in December 2013, and the final rules were adopted in March of 2015. And the structure was based of these new rules was based on the old Regulation A. So it uses that framework, but really creates something that's fairly different than what was in place before Regulation A+. And as we've said before, these rules will become effective tomorrow on June 19th. Now, the last bullet on this slide shows one thing that has been controversial with respect to this Regulation A+, and that is that the offerings under Regulation A+ will be exempt or preempt state securities regulation, which has been controversial from the state's perspective. For many states, not sure that they agree that there should be a new exempt offering that does not require state oversight. So these rules are being challenged currently by the state of Montana and the state of Massachusetts, or the Commonwealth of Massachusetts, seeking injunctions to prevent these rules from going into effect. So there are some challenges to these rules that still need to work their way through the courts. But now let's go to a quick overview of the key features. Okay, so the idea is that under Regulation A+, you can conduct essentially a public offering. So that means that you can engage in public offers, general solicitation, and offer securities that will be freely tradable in the hands of the investors. And you can do it without becoming a full SEC reporting company. But we will see that the nature of reporting depends on the size of the offering. So what the rules created was a two-tier system where you have Tier 1, where you can offer up to $20 million every 12 months. And that is really that Tier 1 is analogous to what was the old Reg A, in the sense that it does not preempt state regulation. It does not require ongoing reporting, except for a report at the end of the process, and it is just a larger exemption. But then there's Tier 2, which is up to $50 million, up to the statutory limit. Every 12 months can be issued in these offerings, and that comes with a preemption of state registration. So that obviously makes those offerings more efficient and more able to be used by companies. And the new regulation also permits this to be used as kind of a mini IPO, in the sense that an issuer can go through a Reg A+ offering, but at the end of the period, at the end of the offering, if they wanted to, they can coordinate a Reg A+ offering with a listing on a national securities exchange, which means they would become would have 12G registration. So you have some flexibility here. You can stay outside 12G and not become a full SEC reporting company, but you can have the flexibility to trade on exchange. So really what you have is a mini IPO process and potentially a new class of small public companies with less reporting obligations, which we will get to, more of a semi-annual reporting context. So those additional requirements are, you can see on this next slide. Tier 2 has some other restrictions and elements that Tier 1 does not have. There are rules about non-accredited investors. You can sell to non-accredited investors if you want to, but there are limits on how much you can sell to non-accredited. You also can lose that restriction if you are going to be listed on an exchange at closing. Tier 2 offerings require audited financials. Tier 1s do not. And if you are a Tier 2 offering, as you said, you go into a semi-annual reporting scheme with also current reports. But as the last bullet notes, if you aren't going to go on to a national exchange at the end of your offering, you may be in better shape going Regulation A+ than you would on a Form S1, where if you're going to be an OTC company, because you get the blue sky exemption from Reg A+. Quickly here, a couple of eligibility points. It's open. Reg A+ is open to U.S. or Canadian issuers, but there are some companies that are ineligible. So if you're an SEC reporting company, you're ineligible. A blank check company, you're not ineligible. Investment companies can't use this. And the new Reg A+ incorporates bad boy disqualifications, which are essentially the same tests as under Rule 506 of Regulation D. The new Reg A+ does, however, have some advantages in some other kinds of contexts. For example, you can use cash or non-cash consideration. So you could use Reg A+ in an M&A context, potentially. It does permit selling shareholders to sell as part of a Reg A+ offering, and those selling shareholders can be affiliates. So you can see the limitations here. There are limitations in dollar amount for Tier 1 and for Tier 2. There's also a limitation of a 30% of the total offering for the first go-round. So you can't have, as your initial Reg A+ offering, you can't have a solely shareholder offering, but certainly that's a distinguishing characteristic from Regulation D. You can't do at-the-market offerings. So you do have to put a price range in or fix a price for your offering. So you can't have it just from time to time at the market. So that kind of fixes one aspect of the type of offerings you can do. So that is a limitation, but it still permits you to do continuous offerings, delayed offerings, but you can't do like the traditional shelf takedown. That probably isn't really feasible under Regulation A+, given the price range requirement. But you can do some delayed offerings, so selling shareholders might be able to use that, exercise or conversion of outstanding securities, and you can do a continuous offering. It just has to be, within a price range or at a fixed price, for your continuous offering. And then one final point here in our overview is, again, going back to this issue of treatment of non-accredited investors. You can sell to non-accredited investors, but if you're not going to be listed on an exchange, then there are income and revenue limitations on how much those non-accredited investors can invest in your offering. But the process with respect to those investors is simpler because issuers can rely on representations. So you don't have to go through an extensive verification process in order to sell to non-accredited investors. So with that, I'm going to pass this on to my colleague Ken Sam, who's going to give us a deeper dive into starting with the offering circular requirements for the SEC.
Well, thank you, John. Good morning, everybody, and welcome to our webinar. I think Reg A Plus is a pretty exciting change to the securities laws, but being a corporate capital markets attorney, maybe that's a little bit of an overstatement. So to begin with, it's important to recognize that Reg A Plus is an exemption in which companies can do public offerings. The traditional way to do a public offering is through SEC registration, and although the processes are very similar, in a registered offering you would typically file Form S-1 with the SEC that goes through a review process. With a Reg A Plus offering, you file what's called an offering statement, and this offering statement is filed on Form 1A. Form 1A existed under the old Regulation A. It's been changed and amended so that it's more of a narrative disclosure. It was an option under the former 1A, and it's very similar to an S1 registration statement when you look at the components. The components of the Form 1A are in three parts. There is the cover information, which is basic information about the issuer, industry, address, etc. The second portion is basically similar to the prospectus that's contained in an S1. And it contains basically a narrative description of the issuer and the offering. Unlike Form S1, which forced you to go from the form itself to Regulation SK, which are the line item disclosures, the SEC has set up Form 1A so that you can just read the form and understand what's required. So it's a little more user-friendly than going through an S1 process. So in Part 2, it has the typical things that you would expect in a prospectus: risk factors, a dilution table, plan of distribution. If they're selling shareholders, you identify the selling shareholders, description of the business, MD&A, information related to officers, directors, and significant employees, compensation information, security ownership information, and information related to related parties. While those same types of line item disclosures are required in Form S1, the requirements of Form 1A are scaled down versions of those. And again, they're designed to be used by smaller issuers that are not necessarily going to be subject to full SEC registration or reporting. Part 3 is simply the exhibits and signature pages. Form 1A needs to be signed by the issuers, executive officers, and the majority of the directors. The Form 1A is subject to full SEC review, and as John indicated earlier, if you're not using a Tier 2 offering, then it's also subject to state blue sky review in the states in which the issuer intends to make the offering. So the similar concept of effectiveness applies to Form 1A, and that's where the SEC has cleared its comments and declared a registration statement effective. For Form 1A, they refer to it as qualified. So once your offering statement has been qualified, you're free to actually sell securities under the Form 1A Regulation A+. all of these filings have to be done and made public under the SEC EDGAR system. There is a process for confidential filings in which, and again, it's similar to the confidential process for emerging growth companies in that the company can confidentially file the Form 1A, go through a review process with the SEC, and then officially file the offer statement with the SEC 21 days prior to the qualification, and after that time, the issuer can sell the securities. Where we have a Canadian issuer involved, they must also file a Form FX, which is a consent service process. The financial statements require the issuer to provide 2 years of financial statements. For Tier 1 issuers, those are the issuers that are selling less than $20 million. They can provide unaudited financial statements for that 2-year period. And unless they have audited financial statements available. So again, offering less than $20 million, if you don't have audited financial statements, you can use unaudited financial statements. For Tier 2 issuers, those are the offers of up to $50 million, and also preempting state blue sky laws. Those financial statements must be audited. The annual financial statements must be audited in accordance with either U.S. GAAP or peekaboo standards. Peekaboo standards is a standard that SEC registrants and reporting issuers have to abide by. The auditors themselves do not need to be peekaboo auditors. In other words, they don't need to be registered with the peekaboo system, but they must be independent. For U.S. issuers, those issuers that are incorporated in the United States, they must use U.S. GAAP. Canadian issuers can use the IFRS financial statements, which are the international standard financial statements. There may be other rules that apply to the financial statement requirements depending on the industry. For example, oil and gas issuers are required to comply with Rule 410 of Regulation SX for oil and gas properties and activities. And the age of the financial statements, the requirement is that the latest balance sheet can't be more than 9 months old as of the date of the qualification. So that's the date, not the date that you file, but the date that the SEC qualifies the offering statement. Filings that are made more than 9 months after the issuer's year-end must include an interim balance sheet and financial statements that are no later than 6 months after the fiscal year-end. So those are typically referred to as interim financial statements, and they can be unaudited. And you'll note that the 6-month period aligns well with the semi-annual reporting standards. So one of the other points and benefits of using Reg A Plus is there's no XBRL requirement. Reporting issuers with the SEC or issuers filing registration statements with the SEC have to format their financial statements using XBRL. And in some circumstances where there's been an acquired business, the issuer may have to provide financial statements for that acquired business and pro forma financial information, very similar to SEC reporting issuers. So everyone's favorite topic is liability. And the question is, well, what liability attaches to a Reg A Plus offering? And the short answer is, under Section 12A2 of the Securities Act, any person that offers and sells securities may be liable for any untrue statement or omission of material facts. And basically that's sometimes referred to as 10b-5 type liability, but it's under Section 12A2. The defense would be that, of course, is knowledge and exercise of reasonable care in preparing the disclosure information. And then also a defense in minimizing the damages is that the statement itself wasn't the cause of the loss. One interesting turn might be how agents and underwriters working on Reg A Plus offerings, what additional requirements they might have. And we think that based on conversations with some agents and investment bankers, they're going to lean toward requiring 10b5 type comfort letters in connection with an A plus offering, a Reg A plus offering. So now looking at the mechanics of the offering itself, we've talked about the contents of the offering statement. An interesting point is Reg A Plus offerings won't be integrated with prior or future offerings. So what this means basically is if an issuer has relied on an exemption to offer and sell securities in the past or moving into the future, those offerings generally will not be integrated. So Rule 701 offerings for compensatory plans, Regulation S offerings for offshore transactions, Reg D offerings, Rule 144A offerings, and private placements under Section 4A2. Those generally will not be integrated. Another feature of Reg A Plus is this ability to test the waters. And this is a pretty flexible tool for issuers. So they can actually test the waters and determine interest in the offering both before and after the offering statement is filed. So this is a very flexible tool in looking at whether or not to complete an offering or to launch an offering. There are specific rules that you have to comply with in order to test the waters. There's this requirement to put a legend on any test the water materials that says basically no money or other consideration is being solicited, and if it's sent, it won't be accepted. There's no sales or commitments that will be made or accepted till after the offering statement is qualified, and any indication of interest is non-binding on a potential purchaser. There's also a duty to update and redistribute after the filing of a preliminary offering statement if you use test the water materials that turn out to be inadequate or inaccurate in any material respect. After the filing of the offering statements, the test the water materials must be accompanied with the preliminary offering statement, or you have to provide them a notice as to where they can access the materials. And the confidential filing process, which I mentioned earlier, you can submit your offering statement to the SEC on a confidential basis, go through an SEC review process. The only requirement is that it must be filed on EDGAR 21 days before the qualification, and all test the water materials must be filed as exhibits. After the filing, an issuer can participate in roadshows, and it's actually okay to make offers. You just can't accept the offer until after qualifications. In other words, no sales until after qualifications. There are specific requirements for participating issuers and brokers to deliver the preliminary offering statement within 48 hours in advance of a sale, and then the final offering statement as amended needs to be provided or made available to purchasers, and that can be done through a URL. I think one of the biggest benefits of Reg A Plus over an S1 is the ability to preempt state blue sky laws. And while Tier 1 doesn't provide that state preemption, and if you in a Tier 1, that's the offering for less than $20 million, you actually have to do your filings with the states in which you offer into. The state regulators participate in a coordinated review process and typically can assist with completing the review, hopefully in a timely manner. But for Tier 2 offerings, this preemption is really a big advantage to issuers. So if an issuer were to offer and sell securities under an S1 on a registered basis and elected not to or failed to qualify for a listing on a national exchange, being New York Stock Exchange or NASDAQ or MKT, it would have to go through a coordinated review process with the states in which it offers and sells securities. The Tier 2 exemption under Reg A Plus provides preemption of state law. In other words, the states can require some notice filings and maybe require the issuer to pay a fee, very similar to Reg D offerings, but it can't review and can't conduct a merit review on the offering statement itself. And that is a big benefit because it streamlines the process for this public offering under Reg A Plus. And again, if John mentioned that you could do a coordinated process in which you register under the Exchange Act under 12B and list your securities with a national exchange. In that case, the offering would be preempted under state law under NISMIA. Okay. The final topic I'm going to cover is once an issuer has completed a Reg A Plus offering, what are the ongoing reporting requirements? For Tier 1 offerings, there is no ongoing periodic reporting requirement. Instead, what the Tier 1 issuer does is file a Form 1Z, and that basically is a statement that you closed your offering and you're done. And the statement requires the date of the offering, the date it was qualified, commenced, the amount of securities offered, the amount of securities sold, the offering price, allocations, and fees associated with the offering and net proceeds to the issuer. For Tier 2 issuers, the requirement's a little bit different. They're required to file annual reports on Form 1K, and it's very similar to a Form 10K report. It has to be filed within 120 days of their year end, and again, it's very similar. It has annual disclosure related to the issuer, and contains the audited financial statements for the issuer for the year. In addition to that, they're required to file semi-annual reports. So these semi-annual reports, in other words, after the second fiscal quarter, needs to be filed on Form 1SA, and it has to be filed within 90 days of the second completed fiscal quarter, and it's very consistent with the quarterly reports that regular SEC reporting issuers file on Form 10Q. And it needs to include unaudited financial statements for that 6-month period. And the final reporting obligation is the requirement to file current reports on Form 1U. And these current reports are very similar to a Form 8K. There are fewer line items that require disclosure, but again, they are due very similar to Form 8K within 4 business days of a material event. And there are line items in which an issuer is required to disclose. And all of these annual, semi-annual, and current reports for Tier 2 issuers are required to be filed on EDGAR and made available to the public. So with that, I'm going to turn the presentation over to Chris Doerksen. Chris is a partner in our capital markets group in our Seattle office, And he's also our firm's blue sky expert. So his guidance is usually very important for Tier 1 type offers, as well as any other exempt offering that you may have questions about. So Chris, I'm going to turn it over to you.
Thanks, Ken. So I'll start by just continuing the discussion that Ken had started about what does a Tier 2 issuer have to do after closing. One of the things is those filings that Ken summarized, but it's important to understand what they're not required to do. So for some of you who may not be as familiar with ongoing SEC reporting, there are a lot of different things that a Reg A issuer under Tier 2 will not have to do that an SEC reporting company does. One is there will be an exemption from the SEC proxy statement requirements. So whenever the company has a shareholder meeting or is going for a shareholder vote on any matter, SEC reporting company has to comply with a very lengthy list of disclosure requirements, timing requirements, filing documents. But a Reg A company could just have the meeting in accordance with its normal practices governed by state law. There's also an exemption from numerous Sarbanes-Oxley requirements, which were some of the requirements that made smaller companies start to be concerned about going public at too early a stage. A Reg A company would not be required to have internal control over financial controls in place, would not have to have auditor attestations of the quality of their financial controls, and would not have to do periodic reports on the quality of their disclosure controls. So there's a lot of internal compliance costs of being a public company that a Reg A company would be exempt from. Also, the insider trading and insider reporting requirements would not apply to a Reg A company. There would be an exemption. The directors, officers, and 10% shareholders would not be required to file reports under Section 16 of their ownership and would not be subject to the short swing trading liability that prevents insiders of public companies from engaging in short-term trading. And then there are also a number of transactional exemptions. So an SEC reporting company normally has to comply with a number of requirements if they're going to be engaging in, for example, a tender offer for that company or a going private transaction. Those rules would not apply to a Reg A issuer. So we expect that the ongoing compliance requirements would be substantially less expensive than being a full SEC reporting company. So does the reporting last forever? That's an important question to consider. And the answer is it depends. A Tier 2 issuer is allowed to suspend reporting by filing a document if it's completed at least one round of annual reporting, and at the time that it suspends reporting, it has fewer than 300 holders of record. And that test is basically an arbitrary test. Holders of record counts the people who are on your actual shareholder register, and then to the extent that you have a depository like CD & Co. or CDS that holds shares, you have to look through that depository one level to the brokers that have accounts within CD & Co. You do not, however, have to do a full look through to beneficial owners. So depending on how many shareholders you had on your share register at the time that you first did a Reg A offering, you may well be able to effectively terminate your reporting after 1 year of reporting. We see many public companies that have fewer than 300 holders of record, and often the answer there depends more on how long the company was around before it went public, where people started to hold indirectly through brokers, than it does as to how many actual shareholders they have. So what happens after your offering? Of course, if you're doing a public offering of free trading securities, the whole point is that people can trade those securities and don't have legends. So you're going to want to have a market available for trading. We mentioned already that a Reg A company is permitted to flip to being a full SEC reporting company at closing. So that's one option. If you can satisfy the requirements to list on NASDAQ or NYSE market or another market, you can file a very easy document to become a full SEC reporting company at closing, which would then allow you to list on one of those exchanges at closing. If you didn't want to be a full SEC reporting company, instead take advantage of the scaled disclosures that we've just summarized, some of the options available to you are the OTCQX market and the OTCQB market. Those are markets that do not require you to be an SEC reporting company. The OTCQX already allows a non-reporting U.S. company to be included in that market and quoted on that market. And the OTC Markets Group is in the process of amending the rules for both of those markets to specifically allow companies that have done a Reg A offering and that are reporting under Tier 2 to be quoted on those markets. One important thing to note is that just because your offering is less than $20 million, you are not required to do the offering under Tier 1. You are permitted to voluntarily do a Tier 2 offering to get the state preemption and to get quoted on the OTC markets. NASDAQ has not yet announced but is also working on a new tier of NASDAQ that would be available for international companies that are not SEC reporting. That has not yet been rolled out, so we don't have all of the details. But we expect that at least for Canadian companies using Reg A+, that's a potential alternative in the future. So we've given you a lot of information, and you know what is the upshot of all this? We're now going to talk about the practical implications. So overall, Reg A+ is a potentially very valuable tool for certain private companies if they're at the right stage of development for this exemption to make sense. It facilitates public offerings with fewer requirements than for a full SEC registration statement, both in terms of the offering itself and the obligations that the company incurs after doing the offering. And it also facilitates crowdfunding. I haven't seen a lot of discussion of this issue, but you know, the excitement of crowdfunding could be very easily manifested through Regulation A+. So some of the types of companies for which we think Reg A+ would be most attractive, you know, one is, you know, a late stage private company. You know, maybe it has a significant business. The business is going reasonably well. It's just not quite large enough to, you know, be a full public company yet, but it needs funds for a particular matter, whether it be, you know, building a new plant or developing a new product, and is having trouble finding those funds on a private placement basis. You know, in that type of situation, Reg A+ may make sense because you can put, you know, the effort into preparing this document, clearing it with the SEC, and then do, you know, one substantial offering of up to $50 million to raise the money that you need for that particular transaction. And you know, some of the downsides of Reg A+ of not being able to do easy shelf transactions, you know, may not be as much of an issue for that type of company because you've got the money raised in your first offering, and that will last you for some time. A second category is a crowdfunding transaction. So, you crowdfunding is something that's become very popular. The Jobs Act directed the SEC to make rules allowing for crowdfunding, but there was a lot of political fighting over the language there because some people thought that crowdfunding would endanger investors. And so the rules really haven't gotten anywhere useful. There were proposed rules in 2013 that are not yet final, and the rules make crowdfunding really unworkable. There's a $1 million limit, there's offering documents required, there's limits on how much each investor can put in that are very restrictive, and there's ongoing reporting requirements. Really not worth it for an offering of less than $1 million. Whereas for Reg A Plus, you really can do a true crowdfunding. You can do a Tier 2 offering of up to $50 million with very limited restrictions on what investors you can bring in, and you don't have to worry about state laws because there's preemption. So a couple of other types of companies that may look to Reg A. A company that is already planning to do an IPO, and this is just an alternative way of doing the IPO. A company might consider Reg A Plus in lieu of a traditional SEC registration statement if they're concerned about costs. They'd like to ease into public company reporting and perhaps put off for some time SEC full reporting compliance and Sarbanes-Oxley and some of those other things that I summarized. Another example is if the company is too small to list on a national securities exchange at closing. In that situation, Reg A Plus is really a no-brainer because it gives a state exemption, which will then allow the offering to proceed, much more efficiently, cost-effectively, and without the risk that you would need to limit the type of investor or delay due to the application of state law. We also see a number of U.S. companies, particularly in recent years, as the regulatory burden of Sarbanes-Oxley made being a public company that much more difficult. Looking at doing overseas IPOs, we have a number of issuers that have listed on the exchanges in Canada, the TSX and the TSXV, on the AIM market in London, and on the Hong Kong exchange. We regularly help companies with all of those types of transactions. Under the existing rules, most of those transactions are occurring by a U.S. company taking over a foreign entity in order to avoid SEC registration, because there are special exemptions from SEC registration that are permitted to foreign companies as long as they meet certain criteria. This Reg A Plus structure would allow companies a new alternative to simply do a direct offering overseas without having to reorganize their entire companies. It would allow a U.S. company to just do a simple, straight offering on those exchanges, and there would not have to be placed any resale restrictions on the shares that are sold in those jurisdictions. So we think that companies will start to look seriously at Reg A Plus for those types of foreign offerings, as long as the offerings are within the $50 million limitation of the rule. And then lastly, we don't see this occurring all that frequently, but Reg A Plus would also provide an alternative for M&A transactions, particularly if the target company is within the size of the Reg A rules and is broadly held by many different people, not all of whom are accredited investors, and where there's no easy exemption for the M&A deal. In those situations, the alternative before was either you can't offer shares to the target shareholders, or you might have to do a full SEC registration statement. This would provide a potential alternative, particularly if the target company is less than $20 million in size, because then you could do a Tier 1 offering. Most states have merger exemptions, so you could probably avoid state registration, and because it's Tier 1, you could avoid ongoing reporting requirements. Okay. It looks like we have time for some questions. So before we move to questions, let me just make an administrative note that because we have some New York lawyers participating today, in accordance with the New York CLE rules, the New York code for this program is ZQR851. I'll now turn things back over to John to introduce the questions that have been asked to the extent we have time remaining. John?
Thank you, Chris. I think I'll kick this off with maybe a question to Ken, because I think one question, on execution of these deals is to, understand kind of the time frame associated. So first question is, how long do you anticipate an SEC review of an offering statement to take? How do you think that process will work?
Wow, that's a difficult question to answer sometimes. So in a typical registered offering process, what happens is the registration statement is either filed or submitted confidentially to the SEC, and the SEC will assign a reviewer, and they'll go through a process. And normally you would expect your comments within 30 days. I've heard a rumor based on some panel discussions from SEC staff that the SEC is going to endeavor to have comments done within 21 days of submission of an offering statement. And then from there, from your initial comment letter, I think it just depends on the quality of the disclosure, whether you have particular issues with financial statements, whether you've met all the form requirements, and for a registered offering, it's not unusual to take 60 days to get your comments cleared. So I think that's probably a good gauge for what the expected timing on SEC review would be.
Okay, well, great. Thanks, Ken. Chris, maybe we can follow up with you. I think that maybe a two-part question for you, Chris, is to, for listeners who may not be familiar, maybe you could give a little bit more detail about listing securities on the OTCQX or OTCQB, those markets, because potentially, some smaller issuers might want to be, in those markets for a period of time, perhaps before growing into a national exchange. And maybe you can also touch on restricted securities and how they might, that were issued before the Reg A offering, how they might be coming into play on if an issuer went the OTC route.
Sure. Thanks, John. So of the two markets that we mentioned, the OTCQX and the OTCQB, the highest tier is the OTCQX. So that's really where a company would want to list if they can. For a company that's just done a Reg A offering and that is not a full SEC reporting company, there are a few requirements that the company needs to satisfy in terms of its qualifications. One is having at least $2 million in total assets, which we assume would be satisfied if you've just completed an offering. There's another standard that has several alternatives, but the easiest is to have at least a $5 million market cap. Again, we're assuming that would be satisfied given a recent offering. The company cannot be a penny stock, and the company would not be a penny stock if the stock price was at least $5 or the company had net tangible assets of a particular level, which is $2 million if the company has been in operations for at least 3 years, or $5 million otherwise. The company has to have at least 50 shareholders holding round lots. The stock price has to be at least 10 cents per share. The company has to sign up to be published in a recognized securities manual, which is basically just a paid service. That there's no question about whether you can do that. You just pay a little money to do it. And then the company has to make certain information public under the proposed new rules, which are to take effect or they're asking for comments by July 10th to take effect right thereafter. A Tier 2 company would have to voluntarily elect to do reports quarterly rather than just semi-annually under the SEC's rules. A U.S. company is also required to appoint a broker or firm as what's called a DAD, which is basically an advisor that acts as an intermediary between the company and the exchange, helping the company comply with the exchange's requirements. Dorsey does provide that service. It costs $5,000 to join the QX, and the annual fee is $15,000. So the upshot of this is that there is a test to go through, but most companies that have just completed a successful Reg A offering should qualify. The QB is a market that could be available if the QX requirements are not satisfied, and under the proposed rules, basically you just need a stock price of at least a penny. You need to comply with the Tier 2 reporting requirements, just the semi-annual requirement, not quarterly. And then that market, it's a $2,500 application fee, $10,000 annual fee. Both markets also require that a broker has filed a document with FINRA, which is the broker self-regulatory body, to get approval to quote the stock, because obviously you can't trade unless there's a broker quoting the stock. Let's see, John, the second part of your question was about restricted securities that had already been issued and reselling those. So under the SEC's Rule 144, a non-affiliate of the company can sell restricted shares after a year as long as the company is not a former shell company. So for most people who have invested some time ago, they could sell probably right after the offering into the market that gets created. For affiliates of the company, however, Rule 144 imposes additional information requirements. And if the company is not full SEC reporting, basically an evaluation would have to be done at the time of the proposed sale as to whether the Reg A ongoing disclosures met the standards of Rule 144 prior to the time of sale.
If I can add on that, Chris. So the 144 requirements would be satisfied immediately after an issuer completes a Reg A Plus offering. In order to have the ongoing reporting or the ongoing disclosure requirement met for 144, an issuer would have to voluntarily file the quarterly financial statements for the first quarter and the third quarter. And after those are voluntarily filed, or submitted to the SEC, then they would be eligible to sell shares under Rule 144 all year round.
Great. Thanks, Kent. Well, I think unless there are some other questions, we have come up to the end of our allotted time. So I think with that, maybe we should wrap things up. I don't know whether Chris or Ken, you have any final comments you want to make before wrapping up and thanking our audience?
Yeah, John, I thought maybe just a final question for you about the ongoing litigation, because that really seems like the elephant in the room here, that we have rules that are set to go effect tomorrow, but we have 2 states that are seeking an injunction. What's your thought about how issuers should view that, and what could happen if people start down the path of an offering and then suddenly the rules are found to be void, and we're back to the drawing board?
Well, obviously that's an interesting question. I think that I guess that is potentially a issue. So I guess we need to monitor that element, but I think in the end, I don't think the SEC is going to turn around and punish someone who is following their rules. So I guess the question is if you get started on the process, you can monitor whether any developments are going to come along. But I think in the long run, I would be surprised if these don't withstand the test, of the challenge. And I'd be surprised to see a court not find that the preemption was permitted under the law. So I think that would, I think they're going to have they're not going to lose this case. And as I say, I don't think the SEC is going to turn around and punish someone for following their proposed regulations, which they believe are correct. So I think there's an ability to have some confidence here to start moving forward on these offerings.
Yeah.
Great. Well, thank you everyone for participating in our webinar. If you have any questions, you can always feel free to email us or to pick up the phone and call us. There were some questions that were submitted that were not addressed, and we will follow up directly with the person asking the question with our response. Again, thank you very much, and have a great day.